for me, anything having to do with taxes and the work that I do creates a bit of queasiness in my belly. So I really appreciate Elizabeth hopefully clarifying some of that and making sure that we are all aware of the side implications of the work that we do. So with that, Elizabeth, the floor is yours.
Hi, everyone. Good afternoon. Let me just say that it's a little, I'm going to do the best I can. When you can't see the audience, it's a little hard to know if I'm confusing you or not confusing you. So if you have questions, please type them in there. Becky's going to read them as I go along, and if they're urgent, she's going to interrupt and we'll answer the questions. Otherwise, we're going to take questions at the end of each section, and these are really what we're going to cover today. Let me just say a little bit about myself. I'm a practicing tax lawyer. I run a clinical program at Fordham Law School. For those of you who haven't heard me speak on these topics before, I became involved in consumer law maybe back in around 2007, and doing the consumer work, which I was new to, I kept noticing all these tax issues, and generally tax lawyers are experts in an area that nobody else wants to know anything about. So here I am. I'm going to talk to you about tax issues, and then I'm going to go through the exclusions that I think are most important to you. I'm just going to cover information returns, a couple of slides on some HAMP rules, little information about tax returns, and then some examples, and then resources at the end in case you need help after this webinar is over. Okay, so first of all, the general rules, for those of you who took income tax in law school or might remember this, gross income includes income from cancellation of debt. Okay, what kind of debt can be canceled? All kinds of debt can be canceled, but I'm going to skip forward because, like I said, I only have an hour. There's an example for you, and if we talk about just like debt that's forgiven or excluded as part of a foreclosure, and for those of you who know, when you sell a principal residence, any income on that principal residence is excluded up to $250,000, and if you're married filing joint, you can exclude up to $500,000. So we have a lot of rules under Section 121 about what a principal residence is, and they're sometimes going to become relevant. Okay. Okay, so let's go to the exclusions that matter most. The exclusions that are found in Section 108 of the Internal Revenue Code, and there's going to be there's a laundry list of them in Section 108A. The first one being that if a discharge of indebtedness, or otherwise known as a cancellation of debt, so I'm going to use them interchangeably. One is cancellation of debt, and that's COD, or discharge of indebtedness, and that's often abbreviated as DOI. But if a discharge occurs during a Title 11 bankruptcy case, then any discharge is excluded from income. If the discharge occurs when the taxpayer is insolvent, that discharge is excluded from income. And then those of you are probably familiar with the qualified principal resident indebtedness exclusion. However, that expired in January 1st of 2014. For those of you who read the New York Times, there was an article on the front page of the New York Times business section about the QPRA exclusion now having expired. Do know that obviously we don't know what Congress is going to do, but Congress can go back and retroactively reinstate the QPRI exclusion. So if Congress decides to act, let's say in June or July of this year, they can go back and say that QPRI exclusions are reinstated back as of January 1. So it's not like they can, if you do something now, you'll never get QPRI. If they do go back and reinstitute it, they can go backwards. Okay, so that we're going to basically focus on these three things today: bankruptcy, insolvency, and QPRI exclusions. Bankruptcy really is quite simple because it only applies when the debt is discharged during the bankruptcy. So it has to occur during the bankruptcy or by order of the bankruptcy court. Okay, so during the court's jurisdiction or by order of the bankruptcy court. So therefore, if you negotiate with your creditors, based on an impending bankruptcy filing, and you get a discharge before the bankruptcy, that's not going to be excluded under the bankruptcy exclusion. Okay, again, it has to be during the bankruptcy or by order of the bankruptcy court. Okay, so I'm going to spend a bit of time on the insolvency exclusion today, and that's just because that's going to be the only exclusion, assuming we don't have QPRI, that's going to be the only or the best exclusion for your clients moving forward. So the insolvency exclusion applies if the person is insolvent when the debt is canceled. Okay, so you can exclude some or all of that debt that's been canceled or discharged. Okay, it's limited. Insolvency exclusion is limited to the amount that the person is insolvent at the moment the debt is canceled. Okay, so you can't exclude the amount to which the person, I'm going to probably call them the taxpayer today because that's what I do. It can't exclude the amount by which the taxpayer is insolvent. Okay, so what is insolvency? And you probably already know this, but it's just the excess of liabilities over the fair market value of the assets immediately before the debt is discharged. So the debt that is being discharged is included in the total liabilities of the taxpayer, and the assets include everything owned by the taxpayer, including exempt assets, including defined benefit plans, including retirement accounts, etc. Okay, so the trick here is to remember whatever debt you're discharging, let's say you're getting a loan modification and the mortgage is being written down by $65,000, that $65,000 is included in the total liability of the taxpayer. Okay, so I have this nice example that I did, and let me go through it with you, and we'll just look at this person or this business. They have assets and liabilities, again, immediately before the discharge. And what are their assets? Okay, so they have three assets. They have cash worth $350. They have an automobile worth $150, and they have inventory worth $200. Okay, and what liabilities does this person have? This person has three loans. Loan A for $250, Loan B for $400, and the loan on inventory for $500. So their total assets immediately before the discharge is they have $700 of assets, and immediately before the discharge they have $1,150 of liability. So they're insolvent, right? Because their liabilities exceed their assets. Okay. Now, in this case, the inventory was devalued by whatever reason, and the bank who lent the money for the purchase of the inventory and agrees to accept $200 in cash to satisfy the entire loan on inventory, which is $500. So the bank who owns the loan on inventory is going to discharge $300 of the loan. So the taxpayer has $300 of income from discharge of indebtedness. Now, if they're insolvent, we have Section 108, which excludes that, okay? And we know the taxpayer is insolvent, so the insolvency exclusion applies, but you need to look at the assets and liabilities immediately after the discharge. So now what are the assets that the taxpayer has after the discharge? Well, now they have cash of $150 because they spent $200 of their cash to give to the bank to, extinguish the loan on the inventory. They still have the auto of $150, and they still have the inventory of $200. So now their total assets are $500. Their liabilities after the discharge are Loan A of $250 and Loan B of $400, so their total liability is $650. So the taxpayer is still insolvent after the discharge. This is the sweet spot. If you want to avail your client of the full exclusion under insolvency, they need to be insolvent before the discharge and after the discharge. Okay? Let me tell you what happens. It's quite common. What we have, we call it partial insolvency. So that means the discharge itself turns the taxpayer from being insolvent to solvent. And when that happens, not all of the debt that was canceled can be excluded. So let me do this example for you. If you look at the taxpayer's assets and liabilities immediately before the discharge, they have cash of $130. The taxpayer has two loans, Loan A and Loan B, each for $100. So immediately before the discharge, the taxpayer is insolvent because they have liabilities of $200 and assets of $130. So what happens? The taxpayer goes to holder of Loan A, and they say, okay, we're going to cancel the $100 loan if you give us $20. Okay, so that means $80 is being discharged or canceled, and the taxpayer has $80 of income. So right after the discharge, now the taxpayer has $110 of cash and a loan of $100. So now the taxpayer is solvent by $10. Now, because the discharge rendered the taxpayer solvent, that means that they can only exclude the income up to the amount that they were insolvent. So here, they had $80 of COD income, but now they're solvent by 10, so they can only exclude $70 of income, and the taxpayer has to recognize that extra $10 when they go to file their tax return. Okay, I feel like I should take a question now, Becky. Do I have a question?
Yes, you do. So the question is, what might be considered inventory?
Oh, sorry. Your clients don't have inventory. That's just an example. Your clients wouldn't have inventory. That's like a business example.
Okay.
Okay. All right. So I want you to, the IRS has a publication, okay, and it has a worksheet in it, and it's publication 4681, and it is like a worksheet. Now, the IRS never gets this worksheet, but you can use it to think about what liabilities your client might have. So what liabilities might your client have? Well, they have a mortgage, right? They might have student loans. They might have medical debt, credit card debt, child support obligations, a tax debt, any kind of judgments against them, old debts from an old business, anything like that, okay? So you want to be looking at all their liabilities, and you can have them really just do this worksheet, right, and just write down everything. Maybe you want to get a credit report. I'm not exactly sure how you want to do this. The little bit of the trickier piece is the asset piece, which is the next page. And this is, again, a worksheet from the IRS publication. Let me just tell you, most of your clients are right. They're going to have like sort of the big two. They're going to have, I guess, a car. They might have a mortgage. I'm sorry, they do have a mortgage, so they own a home. If the home is completely underwater, then this asset, you still include it here, but you know what I'm saying, it'll be less than the mortgage that you put on the other page, cash. If they don't have, the big ones that I find with our clients is retirement accounts. Retirement accounts often throw my clients into complete solvency. And then you can't use the insolvency exception. We get a lot of calls from people who need help because their student loans have been discharged, and you know, that's taxable income, and they want to know if they can exclude any of that. So those are sort of the big things: retirement account, cars, you know, the home. The other stuff that they list here: jewelry, clothing, books, household goods. I mean, you want to, I think, as a tax attorney, you want to be aggressive. I mean, when I think of my books to me are completely worthless. I mean, how much could I sell them for? You know, $50, $100. I probably have to pay someone to come and take them away. Tools, unless I'm a plumber, you know, who wants my tools? You know, what do I have? A screwdriver and a wrench, and so, you know, mostly worthless stuff. By the way, if your client is a plumber and you're thinking, oh, his tools are an exempt assets are included here. So even if they have like a retirement or something that in your you know, legal world you're thinking of as an exempt asset, it's included on this asset side. Jewelry, you know, it's generally worthless. I use the example of, I have an iPad. So let's just say I walked out of my office onto, you know, West 60th Street in Manhattan, and I wanted to sell my iPad. And who's going to buy my iPad? What are they going to pay for it on the street? You know, I'm not going to get that much for it. So you can, I think, be a little bit aggressive here when you're valuing these assets. Let me just see here. Hold on. These worksheets are in IRS publication. Hold on. Let me go up for you. My computer's not cooperating. Hold on. Here we go. These worksheets are in IRS publication 4681. So if you go to the IRS, let me just do it for you really quick. If you go to the IRS website, I have it ready for us here, and you just put in here publication, see what I'm doing, everyone, publication, what did I say, 4681. I just do that, and I search. It should come up, and that's how you find it, really. Or you can just go to regular Google. And just be careful when you go to Google that you're opening up an IRS.gov website, okay, because there's a lot of people trying to sell your client stuff on the internet there. Okay, so where was I? I was here. Okay, so that's where you can find those worksheets. And the publication actually has information, but again, whenever you read an IRS publication, all the stuff in it is always going to, anything that's in the area of gray is always going to lean to the side of the IRS. Although generally the publications are in very easy to understand English. Okay. All right, so that's basically insolvency. You know, if they don't change QPRI, you're going to need insolvency, and it's going to become very, very important. And I'm going to talk to you at the end about some resources that you can use to try to find help for your clients should they need to make these determinations, and you want them to be able to speak to, you know, a tax expert. Okay. So again, the QPRI only excludes COD income from discharge of qualified principal residence indebtedness, you know, between January of 2007 and December of 2013. It only applies to acquisition indebtedness, and that is defined in Section 163H3B, where we learn about mortgage interest and the deductibility of mortgage interest. There's a $2 million limitation, or $1 million if you're married filing separately. Again, QPRI only applies to your principal residence as defined in Section 121. Hold on, everyone. I'm sorry. There's special rules when you sell your principal residence. I mentioned them to you, that a certain amount of income is excluded. Then there's a 5-year look back for what to determine what your principal residence is, and that doesn't qualify for QPRI. Okay, and remember, the discharge that qualifies under this exclusion has to be directly related to a decline in the value of the home or the taxpayer's financial condition. So, you know, this isn't going to apply in a case where you're fighting with the bank because of some kind of malfeasance, maybe, and that you get you get some concessions during, like, a proceeding, a foreclosure proceeding or whatnot. Again, these modifications have to be because of a decline in value of the home or the taxpayer's financial condition. Okay. All right, so what is acquisition indebtedness? Acquisition indebtedness is debt incurred in acquiring, constructing, or substantially improving the home and is secured by the home. So that can include a refinance, that can include a home equity loan, that can, you know, include a purchase money loan. But if the refinance or the home equity loan is used for something other than improvement to the home, then it's not QPRI. So let's just say your client does a refinance and they get another $50,000 in cash from the refinance, and they use that to pay off a medical debt or a student loan or to buy a car. That's not going to count as QPRI. That's not acquisition indebtedness. So any money they use that doesn't go directly to the home is not acquisition indebtedness. Now, let's say they put a new roof on the home. That would be. They redo the kitchen. That would be. You know, they add a wing to the house or something like that. That would be acquisition indebtedness. All right. I have an example here. Basically, I just try to put a foreclosure and a cancellation of debt income together in this example. So I'll try to go through it for you. So here we have our clients who purchase a home for $200,000, and at the time they get a mortgage for $185,000. And at some point they refinance the mortgage for $225,000. Okay, so now they're getting this $40,000 in cash. And they use the $40,000 in cash to do other things. They go on vacation, they buy a car, they send their kid to private school, whatever in the heck can they do. And then the house goes into foreclosure. And upon the foreclosure, the fair market value of the home is $170,000. Okay, so what kind of cancellation of debt income do they have? All right, so the debt being discharged is $225,000. That's the total amount of the loan. The fair market value of the house upon the foreclosure is $170,000. So the bank takes the house and cancels the loan, and the client now has $55,000 of cancellation of debt income. Okay, so now how can we exclude that $55,000? We want to exclude that. That's our goal. Okay, so what we do know is that $40,000 that they used to, you know, go on vacation and buy a car and is not acquisition indebtedness, so it doesn't count for QPRI. So the only thing that counts for QPRI is whatever is not that $40,000. So remember, the whole COD was $55,000, and the only thing we can exclude as QPRI is $15,000. All right. So now we have this other $40,000 that we want to exclude. So how are we going to exclude that? The only thing you can do is try to use insolvency. Whoops. Or, you know, maybe you have bankruptcy, etc. But again, you know, you'll have this amount of money that is not going to be excluded. Okay. Now the taxpayer does realize a loss on the foreclosure. However, since your home is considered like a personal asset and not held for the production of income, it's not deductible. Okay. Let me give you a couple other examples of things that are not statutory, but well, other statutory reasons that don't result in COD income. Okay, so any kind of gift. So let's just say you decide to buy a home, and Aunt Sue gives you a mortgage, and then you can't afford to pay, and Aunt Sue forgives the mortgage. Well, when Aunt Sue forgives a mortgage, that's considered a gift, so that is not income to your client. If Aunt Sue dies and the mortgage is forgiven upon her death, then that's considered a bequest or an inheritance, and that is also excluded from income. You may realize this, that certain student loans are now excluded if the person who works in a certain profession for a certain period of time. So if the student loan is extinguished because of that, that's excluded from income. If you buy the property from the seller, and then the seller is the one who loans the money for the purchase of the property, and you decide that you paid too much for the property, that's called a purchase price reduction, and that can be excluded under 108E5. If you negotiate for a lower interest rate and on a qualified mortgage, whatever interest I pay I would be able to deduct, so any kind of lowering of an interest rate or interest payments is not taxable income. That's excluded. Let me just say there's a revenue ruling, and it basically says that if a person buys a home or does some kind of home improvement with a home equity loan, even when there's a third-party lender, if the person who owns the home has problems with the work, either there was misrepresentation of facts, or there was fraud, or the seller you know, lied during the original sale or during the original negotiations for the improvement to the home, like a builder or a contractor, and so you have a bad actor who, even though they're not the lender, negotiated with the homeowner for the new loan or the improvement to the home. You can use that argument to say when the lender cancels some of the debt, that it relates back to those bad acts of this third party, and try to exclude that canceled debt as part of this 108E5 purchase price reduction. Okay, what else do we have for other kinds of exclusions? Well, there's disputed debt, and so like the best example I could give as a good faith dispute, like in a credit card, like it wasn't your debt, it wasn't your credit card, someone stole your card, it was an unauthorized charge, etc. So you may be able to, you know, take those series over to the mortgage area. You know, maybe there was, you know, lies or malfeasance during the negotiations for the mortgage or with the mortgage broker, etc. The debt isn't legally enforceable, so if you took income tax in law school, you read a case about a casino, and the casino lent the taxpayer money in excess of what they were allowed to lend under the law, and so the court said that that actual debt wasn't, since it wasn't enforceable, the taxpayer didn't have income from the cancellation of debt that isn't legally enforceable. And then again, anything time that you contest the liability itself, you can always argue that if you're contesting the debt itself, the liability itself, that it doesn't really exist, so it can't be canceled. If the debt can't be canceled, then you don't have income. So that really relates back to not when you're just saying the terms of the loan were egregious or the repayment of the loan on the terms is unfair, but actually about the loan itself, that the validity of the loan itself is in doubt. Okay, things to keep in mind when you're negotiating, though, just in case you need something more to help your client out of the eventual tax bill they may find themselves having to pay. Okay, some other exclusions from income. There's a lot of federal and state statutes that regulate creditors' action, and again, they give rise to legal arguments. Again, we talked about the debt being disputed. If you have a TILA case, TILA leads to rescission. When you have rescission, that means the debt never existed, so you can't cancel a debt that never existed. So I would think after a TILA rescission case, you don't have income. Again, there's other state statutes and other things that make that not legally collectible. There's a case where some state attorney generals sued some banks for unfair lending practices, and they resulted in a monetary settlement, which the attorney generals then were going to distribute directly to homeowners, and and then there was going to be principal modifications to their loans as part of this big wide settlement. And basically what the IRS said was, look, because what happened here was that the states were saying the lending practices of these banks, of these bad actors, were unfair, then the actual reformation of the loan, this equitable reformation of this loan, is not income because the loan was really invalid under state law or unfair under state law, and therefore any reformation of that loan is not income to the homeowner. And this, I think, is a good argument that you can make if you're in a case where you're dealing with a bank and something funny went on and you're trying to get a modification because of that. So, you know, other ideas to use if you can't have the, whatever the modification is excluded from income under the easier three things we covered: bankruptcy, insolvency, and QPRI. All right, just one note, when you get to actually dealing with this in detail at the tax level, I have a basis in my home. What my purchase price is my basis. If I get a mortgage modification, and that would not change my basis, but if I'm going to exclude the income from that mortgage modification, basically I have to adjust my basis. And so there's what we call a reduction of tax attributes, which for your client's purposes are really just a basis reduction. If you exclude income, you have to reduce the basis of your in your home. Okay. All right. So we are at the end of part one. I'm going to wait a couple of seconds. If anybody wants to type in any questions, I'm happy to answer them.
Right now.
Okay. Either you're all completely confused or you totally get everything. I can't tell. Okay, so we're going to go on. We're going to talk a little about information returns. Let me just say that I only see the information returns like the few people that sort of call the clinic when they want legal advice when they get an information return. I don't see a ton of them. I don't know if you're seeing them because they probably come out like sort of later after your cases are settled. I don't know if your clients come back with them. So I'm going to sort of go through them. I'm not as much as an expert on exactly what happens with these forms. So if people have questions or comments, please feel free to give them to us. All right, so there's basically two kinds of information returns you can get from a mortgage modification or a foreclosure. And the Form 1099-A is the big one, which is going to be used in a foreclosure or a deed back where the property title changes, okay? And the other one is a Form 1099-C, which is for cancellation of debt, and that's for any type of mortgage modification or other canceled debt, like the student loan cases. We see 1099-Cs. Now listen, the bank and the servicers or the financial institutions have a legal obligation under the Internal Revenue Code to prepare and file these forms. They were due last Friday for 2013, so people probably are getting them right about now. They may be calling you, I'm not sure, but the banks are required by law to issue them. It's usually very difficult to, negotiate with them over the issuance of these forms. Okay, so on the Form 1099-A, the lender is supposed to report the amount of the debt owed, which is the principal only, and the fair market value of the secured property. Now, whenever I give these talks and whenever I talk to people who do this kind of work, the kind of work that you guys do, everyone says the same thing. The 1099-As are never correct. So the fact we're going to talk about what you do in your 1099-A is incorrect. But one thing I can tell you is it never hurts for the homeowner when this is going on to try to get a fair market valuation of their own and then keep that, because then it's contemporaneous. And it could be something as simple as getting someone in, a realtor, and having them write down on a little piece of paper with their letterhead saying, today on February 5th, 2014, I looked at this home, and the fair market value of this home based on my expertise is, $312,000. And so it never hurts for the homeowner to get that during the process and then to keep it in their files, because what you're going to find is next year, after you do your modification next month, next year when you get that 1099-A from that lender, the fair market value is not going to be what you think it should be. And then you're going to have to find someone who's willing to go back and value the home as of a year before. Okay? And that's not always so easy to do, and those kinds of experts cost more money than the ones that will come in today and tell you how much the home is worth. Okay, on the Form 1099-A, the debtor or the homeowner is supposed to use these values to determine their gain or loss on the disposition of their property. Okay, so I stuck a 1099-A in here, and as you can see, there's all these boxes, and they're supposed to be filled out. And again, my understanding is they're generally not correct. The balance of the principal is never correct, et cetera, et cetera. So let's move to the 1099-C. Whoops. Okay, on the 1099-C, the lender is supposed to report the taxpayer's name, address, and social security number, the amount of debt that's canceled, the actual date of the cancellation, and the reason why the cancellation is being reported. And that relates to some issues that don't really apply in mortgage modifications and foreclosures. And the debtor is supposed to take the 1099-C and either report the income or exclude it, tell the IRS why it's excluded. And we're going to get into how they do that in a few minutes. Okay, so here's a 1099-C. Whoops. Okay. Okay, so let's just talk about when these forms are wrong. Basically, anytime the form is wrong and you go look at what the IRS has to say or you call the IRS is always, always, always going to say you got to go back to the issuer and have them correct the form. Well, that doesn't happen. You can go back to the issuer 1,000 times in 1,000 different ways, and it's very difficult, or I've actually never heard someone tell me they got a corrected form. So that's not going to work. So what are you supposed to do with your incorrect 1099-A or incorrect 1099-C? Well, then I think you're supposed to report the transaction correctly under the law, and you're going to need to attach some kind of statement to the tax return explaining to the IRS why there's a discrepancy between what's reported on the 1099-A and what's being reported on the tax return. Okay. I think your clients, the homeowners, the taxpayers should be proactive in reporting exactly what happened on their returns. If they ignore the whole thing, if they ignore the whole 1099, they're going to get kicked into an audit. It's always easier to be proactive rather than to be kicked into an audit and try to be fixing with things. Let me just say something else about our friends, the tax return preparers, and I don't mean to be, well, let me just say this. If you have an incorrect 1099-A or an incorrect 1099-C, you need to go to a tax preparer that's pretty sophisticated. And the guy who has the shop on the street, that with a sign that says notario, travel agent, money orders, tax returns prepared, he probably doesn't know the rules as well as I do. He probably doesn't know the rules as well as even a commercial preparer at a paid site. So you want to be, if you think your client's, going to get like sort of in a bad situation because of a mod or a 1099A or a 1099C that's incorrect, you want to make sure that they're going to a reputable tax return preparer. The IRS, I'm going to go back to the IRS website now, which is here. If you go back to the IRS website, one of the great things the IRS has information for is free tax return preparation, and usually there's a link right here. Here, free file. You see this free file? The IRS has a way that you can use their software to free file. If you don't like that idea, you can go to free tax preps by volunteers, and there's something called a VITA program. And if you go to the VITA program, and you can find a VITA site near you, if you see this down here that I'm clicking, if you don't remember, it's for volunteer income tax assistance, and if you just go in the IRS search box and you click it, you're going to get there. And again, you're going to get right back to the page that I was at. And if you want to find a VITA site near you, you can just go in here. And I want to find a VITA site near me. And I want to continue. I'm sorry. And then I'm just going to put in my client zip code. And I'm going to do this. And here they are. Now, I can tell you these are all free. Many of them, you're going to need an appointment for a more complicated return than they're used to doing. Many of them, the actual volunteers, are not the ones who are going to be able to do these returns, but the people who run these sites are generally very smart and capable CPAs, accountants, and tax return preparers. So you may actually need to meet with someone who is higher up in these organizations for these kinds of returns. And again, I always recommend to my students when we're trying to make these connections between our clients and a tax return preparer that we call first and sort of tell them the problem. And many of them won't let you come, in February because this is the very busy, like, earned income tax credit season. And so many of them will ask your client to come later in the season. But many of them will work with you and possibly do the actual returns for you. So just note that to yourself there. Okay. Oops, I lost my control box. How did I do that? How did I do that? Oh, there it's back. Sorry, everyone. All right, so that is pretty much the end of part 2. I'll give you a minute if people have questions or comments.
So there's a couple of questions. The first one is, any difference between a recourse and a non-recourse loan, COD?
Okay, so sometimes I talk about this stuff to national audiences, and in other states, they have these loans that are recourse and then are non-recourse, and then and so there's this complicated things. There's no difference for our purposes, and I don't think you see non-recourse loans in New York State anyway. But there's no purpose. It's still income under certain internal revenue laws.
Okay. So the next one's very good question. With the Mortgage Forgiveness Debt Relief Act currently expired, would CDBG funds which are allocated for home repair but dispersed in the form of mortgage liens, and that would not only just CDBG funds, but there's lots of different programs out there for this type of program, but dispersed in the form of a mortgage lien that are forgiven after 5 years or 10 years or whatnot, is that considered taxable?
Okay, I don't understand the question, so maybe you can try to explain it to me, Becky. What's exactly going on?
Okay, so these programs, we call them soft seconds typically. So that you have a home that is in need of repair. Let's say the city has a grant program or CDBG, which is a federal funding thing, and they say, okay, here's $5,000 to get a new roof, new windows, whatnot. And we're going to put it on as a lien on your home. And if you leave your home before those 5 years, it is repayable. Or if you sell your home or whatnot. It's payable. However, and many of them actually are, they're either forgiven all at the 5-year mark or 10-year mark, or some of them have like a, 25% is forgiven the first year, 50% the second year, something like that, instead of a tapered scale. But at some point, they go away. They're forgiven. The loan.
I would assume those are excluded under the general welfare doctrines, just like you know, any other kind of like payment from the government to a person, and they're not income. And if you're saying like, oh, so what you're saying is at some point it becomes a loan, and that's repayable, and you don't pay it, I would assume that might at that point give rise to COD income. I'd have to actually do research. If that person has like a real case, and they want to ask me that question, at the end is my email. If you want to just email me, I might have to look into.
Yeah, this is actually it's a pretty common situation. I know a lot of clients, certainly in upstate New York, I don't know how common it is downstate, but upstate there's a lot of these kind of programs for home repair and sort of economic development type stuff.
So the homeowner, let's just say, makes the improvement, and then before the 5 years expire, when the grant is sort of forgiven, they're foreclosed upon, or they have to sell. Is that what you're asking me?
Well, foreclosed upon, it doesn't matter. It sort of goes away through that foreclosure process, right? But this would be more of they sell the house, and they have to repay. If it was before the 5 years, they would have to repay part of it or all of it. But of course, then it's not taxable at that point. But it would be after that 5-year mark when it is forgiven, or it becomes.
Oh, yeah, but okay. So let's just say if you get past the 5-year point, it's forgiven. I don't think that's income, because I think again that's covered by the general welfare doctrine.
Okay.
If it's not forgiven and you don't pay, then that might give rise to income. But I'm not sure if it gives rise to cancellation of debt income or just general like income. You know, I'm not exactly sure.
Okay. So if there is something that's a little bit more nuanced, like you're describing, and somebody's facing that, they can give you a call. I've never encountered something at that level of nuance that you're describing. Most of the time, it's just after 5 years or after 10 years, the loan, the grant it essentially becomes a grant and it's forgiven.
Right. So what you're really saying to me is there's never really a loan. It's just like a contingent grant, right? That you have to keep your home for that amount of times. And I would say it's just like any other payment that the government gives you. You know, once you meet the terms of it, it's not going to be income to the homeowner. The other thing about this is government agencies are not so good at filling out these forms correctly. So if you're not hearing anything from the government agency, the IRS isn't hearing anything from the government agency, nobody really knows what's going on. And I would think that, again, once you get past the terms, it's excluded for you know, other reasons.
Okay. All right, sounds good.
Okay.
Those are my 2 questions I have here.
Okay. Okay. All right. So I'm going to go to some HAMP rules. I'm not a HAMP expert either. I know a little bit about HAMP, but just so you know, I did some work with the National Consumer Law Center on some HAMP rules back when they were negotiating with the IRS about this stuff. Okay, so any incentive payments under HAMP don't count as income, and again, these are all considered general welfare payments, and that's why they're excluded. And the IRS, made specific rulings on all these things as these programs were, starting to become up and running, because obviously the tax consequences of these kinds of things can be very, very serious. So all these rulings sort of came along a piece at a time. But any borrower incentive payments under HAMP don't count as income. Payments to the investors to encourage reductions and loan mods don't count as income. And payments made on behalf of the borrowers under this hardest hit program, again, don't count as income. So those are all excluded from income. If we can just talk about HAMP mods for a minute, my understanding about how HAMP mods work is they basically spread the reduction out over 3 years. With, I'll assume my own horn, a little help from me and some other very important people, got the IRS to issue this RevProc, basically at these modifications. And the most important thing you need to know is, especially now that we don't have QPRI anymore, or we might not have QPRI anymore, is that they're allowed to recognize the forgiven, the income, they're allowed to recognize the income. And at the moment that the modification goes into effect, it's probably the highest likelihood that your homeowner is insolvent. So the permanent modification is executed. Let's just say it's executed on November 1st, 2013. You're allowed to take all of that income in 2013 and then exclude it all under QPRI. Instead of having take it piecemeal, part in 2013, part in 2014, part in 2015. And that maximizes your use of insolvency and QPRI. And it also helps probably, if you're like me, many of your clients aren't terrific, they're not terrific record keepers, and it certainly simplifies their record-keeping responsibilities and their accounting responsibilities. Okay. All right. So let me just tell you a little bit about, and we're going to get back to HAMP when we do the examples. So basically, let me just tell you about what you do when you're reporting this kind of stuff on your tax return. So if you have this 108 exclusion that applies, again, the client doesn't agree that the amounts reported on the 1099 is income or that the mortgage modification is income because there's some specific reason why it's excluded under that statute. So remember, we talked about 3 reasons: bankruptcy, insolvency. Come back. What happened to you? On line E, you would check line E, and then on line 2, you would just put the amount that's excluded from gross income. All this does is gets attached to your tax return and filed, and that's it. Your client should not hear anything from the IRS. Bing, bang, boom. Okay? And again, you're just going to sort of fill this out as it is. Again, most reputable tax preparers will know how to do this. I don't know if I would assume at VitaSites the volunteers are not trained on this form, but the people who run the place know what to do with it. And I'm also telling you what to do. Like I said, sometimes we fill them out for the client and send them out to the tax return preparer because we don't actually prepare the returns for the clients. Okay? So if you have a clearly delineated reason, you can use this form. Again, bankruptcy, insolvency, QPRI is right on this form. If you don't have such a good reason and your client doesn't have one of those reasons, you have something else or something weird going on, basically what a good return preparer will do is attach a statement to a return. And it'll just be like Statement A or Statement 1. And they'll type out a couple of sentences explaining what's going on. Now, I've seen audits based on those statements because the statements are generally ignored. Again, it's not a form. The IRS doesn't always look at your return. They don't know what to do with them. Many electronic returns have trouble with statements. So there's also another form, and it doesn't exactly apply, but it's the best form I can think of to use. So if you get a 1099 that's wrong or excluding income for another reason, maybe a TILA rescission, maybe there was a disputed debt that you were arguing with the bank and the homeowner, basically what you're saying is that the homeowner doesn't have income, there's this Form 8275, and you can just use Part 2 to give an explanation of what's going on in your tax return. Okay. And again, I don't think this is something that a volunteer at a VitaSite could do, but I do think this is something that a reputable tax return preparer can do. Okay. Let me just say, you might get into a situation where you're going to recommend your client amends an income tax return, and you have basically 3 years to amend your income tax return from the later of the due date of the return or when the tax was paid. And amended returns are just used to make changes to original returns. They can be used to admit income that you improperly reported. They can be used to include income that you didn't include. But again, reputable tax return preparers know how to amend income tax returns. And I am going to get into an example of when you might want to amend a tax return when we get to the examples. Okay. Do you have any questions? Becky, any questions?
I don't see any more.
Okay, good. All right, so here's some examples. So here's just a regular non-HAMP modification. There's a single homeowner, and they owe $188,000 on a $100,000 house, and they make about $40,000 a year, and you get them a modification with the principal of the mortgage reduced to $115,000. So now we have discharge of indebtedness or cancellation of debt income of $65,000. Okay, so how can we exclude that? So again, listen, if you're not excluding it, this person's taxable income, you know, these numbers aren't exactly correct, but it's going up by $65,000. That's a lot of money. I don't know how this person's going to pay an $11,000 tax bill. They're probably not going to be able to pay it. And there's other issues. But so what exclusions do you have? Again, if it was last year, you'd have QPRI. You might have insolvency. Again, you might have bankruptcy, or you have a disputed debt doctrine. So again, this is just a simple explanation. How do we get this $65,000 here excluded? You know, again, there's basically these exclusions that we discussed today that you can try to apply. Okay, Becky, I'm going to keep going. If you see a question, you just let me know. All right, example 2, we have married married homeowners, and they owe $408,000 on their $120,000 home. They make about $73,000 a year, and they're offered a HAMP mod in 2013. And the total reduction is going to be $270,000. And my understanding of how HAMP works is if they stay making their payments each year, the principal will be written down by $90,000. But the total write-down will be $270,000, and they're going to get this additional good standing incentive of $5,000. Okay, so now just know that the HAMP incentive payment is excluded. We talked about that before under the general welfare doctrines, and any payments to the investor is also excluded. So what's going on here? You have two choices, okay? You can recognize the $90,000 of income in each year over the next 3 years, but in each year that means you're going to need a new exclusion. So for 2014, you're going to have to find an exclusion. And remember, these are the 4 big ones that we talked about here at the bottom of this slide. And then in 2015, you're going to need another exclusion. And in 2016, you're going to need another exclusion. So basically, you're going to have to do an insolvency test every year for the next 3 years, okay? Or if it's 2013 and you can recognize it all in 2013, then you'll have a QPRI exclusion for the whole $270,000. And if you don't have QPRI, it's going to be more likely that your client is insolvent at the moment that the HAMP is agreed upon. And so if you're going to use insolvency, you want to use it for that whole big $270,000. Let me just point out a couple of things that are going on here with timing issues. Always important to tax people, timing issues. You don't have to make this election about whether to exclude the whole $270,000 at once or $90,000 a year until you file that first tax return. So if it's 2013 and I negotiated this deal, this HAMP mod, to get this $270 mortgage reduction, I don't have to decide what I'm going to do till I file my 2013 tax return, which is now, or maybe on April 15th, or maybe I go on extension. But the determination about whether you're insolvent or not, if I'm not going to be able to use QPRI and I have to determine whether I'm insolvent or not, that insolvency test is done at the moment the debt is forgiven, not when you file your tax return. So your client's supposed to tell you what their assets and liabilities were when they put their name, their signature on the contract that gave them the modification. So the insolvency determination is made at the moment the debt is discharged. The determination of whether or not you're going to try to exclude a HAMP mod all in the first year, then that's done when you're filing your tax return. And then if you decide to do it piecemeal, $90,000 each year, you're going to have to make an insolvency determination at the moment each piece is, the contract says that $90,000 is excluded or written down, whatever terminology we want to use. Okay, I'll stop for a second in case I have questions.
Okay, so there's one question. Oh, there's another one here. Hold on.
Okay.
Again. So the first QPRI applies regardless of retention or disposition of property, right?
Yes.
Okay, simple enough. And then the next question here is, let's see, my box is quite small. Enhanced principal reduction. What about borrowers who don't normally file a tax return? For example, their income is from retirement.
So, okay, if you have $270,000 of income from this, you're going to have to file. You're going to probably get some kind of tax reporting form, and we call them information returns, from the lender or the investor in the mortgage. So something's going to come, and you're going to have to do something. They're going to have to file.
Okay.
Okay. Again, if you just look at my first, if you look at this example, and here's a guy, and maybe they don't have employment income. Maybe they just have, Social Security income or some kind of disability income or other kinds of income that aren't requiring the person to file a tax return. They're still going to have to file a tax return because they still have to deal with this $65,000 of discharge of indebtedness. Okay, so and then maybe the only time they have to file, but they need to file.
Right. Okay.
Any more?
The next question is, one more so far.
Okay.
Why would someone not take the deduction the first year rather than over the next 3 years?
I have no idea, and like I said, the NACA people and the NCLC people fought really hard to get the IRS to agree to let them take the reduction all up front. There might be some peculiar reason. Now, who knows, maybe, I don't know, they're going to go further into debt because they have student loans that they're going to be taking later on, and they think that they'll be more insolvent in the next few years, but that's like, having a crystal ball and understanding it. Certainly without QPRI, it makes a lot more sense to take it all at once because it does, again, increase the likelihood that you're insolvent. Now, listen, if you're not insolvent and you're never going to be insolvent, let's take our homeowner who has a retirement account. They worked throughout their lives, and they have this money in a retirement account. You get them a HAMP mod. They want to take the income. If it's going to be income, they want to take it piecemeal over the 3 years. They don't want to be paying tax on $270,000 in year one. You'd much rather pay tax on $90,000 a year for 3 years because your bracket's going to be lower, and the amount of tax, $1 today is worth more than $1 3 years from now, right? So you always want to pay tax later than sooner. So if you're going to be paying the tax, if you don't have an exclusion, you certainly want to recognize the income over 3 years. If you have an exclusion, I think it behooves you to try to do it all at once.
Okay. So far, I don't see any other questions. I know Michelle, never mind, here comes another one.
Okay.
Let's see. I have a court-ordered stipulation that a cash for keys settlement was to be completed in November 2013. But the bank has been sitting on the settlement agreement, and it's still being edited. The discharge was supposed to be in 2013 by court-ordered STIP, and now it's 2014. If the bank is required to report the 1099-C, does my client have any options besides insolvency if there's a court-ordered STIP?
Okay, so I think what you're saying is you have a settlement for 2013, so you would have a QPRI exclusion. Is that right? Can you type in there, person? In 2013, but now because the bank's dragging its feet, it's 2014, and maybe you don't have QPRI anymore, and now you're stuck with insolvency. That's certainly an argument.
The follow-up is the agreement hasn't been signed yet.
Okay. Yeah, I think that you're going to have to hope that QPRI gets extended, or you're going to have to use insolvency, because I think the discharge doesn't occur till the agreement's signed. And maybe, if you and I talked privately, we could think of a way that the agreement actually occurred when you got the court order. I don't know. I'd have to see the court order. You could write it out and email it to me. I could look at it. In other words, whatever happened in 2013, maybe we can argue somehow that that's the moment that the debt was canceled. And if the debt was canceled in 2013, then you have QPRI.
So here's my follow-up question, only because one of my grantees have asked a very similar question, not quite the same, but very similar. So one of the ideas that we were tossing around was maybe if they could make the agreement, even though it's going to be signed in 2014, that the terms would say that it went into effect December 31st, 2013?
Yeah, that the debt was canceled as of 2013, December 1st, 2013.
Yeah,
I think you could probably put that language in, and it might pass muster. It might not. The likelihood is no one's probably going to look at it. And if they do, what a fun case for my students to litigate. I think especially where you have like an ongoing thing where the court is telling the bank to do something and it's just taking a long time to get it done, you might get there. I don't know. You're not really supposed to manipulate everything for tax purposes, so it's more of a case-by-case basis. I'd have to see.
Isn't that what everybody else? Isn't that how normal people operate?
Yeah, of course. But when you get caught, in other words, the moment that the debt is discharged, that's the moment that you're supposed to determine whether you have an exclusion that applies, right? And so what you're saying is you're writing a contract that says, pursuant to this court case or this court order, this debt was discharged in 2013. I don't, so I could write a lot of things. You and I could come up with a contract that says, the moon is made out of American cheese, but that doesn't mean it's made out of American cheese. And the IRS isn't bound by that contract that you and I signed, right? The IRS is bound by facts and circumstances, and they're always going to say the substance of the transaction is what matters, not the form. And whenever these tax courts look at things like this, they always look at substance over form. So the contract is the form, but what really happened. So, I'd have to know more about the facts to see how, how strong of a legal argument we could make. And again, this is all premature because we really don't know what's going on with QPRI, and I don't know what Congress is or isn't going to do. I can't speak to that. But hopefully, you'll get a little relief for another year or two.
Okay.
Okay.
All right.
Anything else, Becky, there?
No, I think that's it.
Okay.
I'll give you like 30 more seconds to hit.
Okay, so let me just do this last example. Now, okay, we talked about these timing issues actually already. So this last example is a TILA rescission. And remember, rescission, so we have a TILA rescission. The homeowner gets a damage claim, and the attorney's fees are given to the legal services organization. Okay, so again, any kind of TILA rescission is always not going to be taxable, again, because TILA is never existed to begin with, and any kind of damage claim is always going to be taxable, and anything that goes to the legal service organization is excluded under a specific rev proc. Okay, I'm going to show you some resources. Here's some of the resources I showed you today while we were talking. So if you want to look at these are tax clinics like mine in New York City. Here are other tax clinics in New York and New Jersey and elsewhere. These clinics do not file tax returns, but they can give your client legal advice. They can give you legal advice while you're negotiating your settlements. So you should find that some of them are sitting right across the hall from you right now. And if they're not, you should feel free to call them and ask for legal advice. These are tax experts, and they can help you, and they can help your clients. And we get a lot of cases that aren't so much fun, so these cases can be fun for us. And everyone always wants to work on a case that's a little bit different. So feel free to call and reach out to people for tax advice as you're going along.
Could you move it back to the upstate page again?
Yes, here you go.
Perfect, thank you.
So you have Albany Law School, Syracuse Law School. There's an Erie County volunteer law project you might be able to get help from. I have a friend at Rutgers. She probably could help you if you're in a jam and nobody else has time or energy to be able to help you. And then there's other tax clinics in other states and other places listed in IRS publication.
Okay.
And I'm trying to convince one of my students to get up there to Albany and start a tax clinic, so that, to help the Albany Law School can only do so much.
And just as a reminder, everybody should have a copy of the slides. Michelle sent them around earlier today, I believe, so you can review them again at a later date. All right, so one more question, and we'll...
and here's my contact information. Okay, one more question.
Okay, one more question. Looking back at slide number 20.
Okay, that's my foreclosure example.
Okay.
Okay.
Okay. Oh, you there?
Here we are, slide number 20.
Okay. Is the $55,000 cancellation of debt from the foreclosure considered earned income? If so, why? Since it went through foreclosure and the bank can seek a deficiency.
Okay. Well, if you end up paying. You mean what you're saying to me is the debt isn't actually canceled. What you have there is a deficiency judgment against the person that they may eventually pay. I mean, I guess that depends. That's a timing issue, right? So if the bank is going to go ahead and try to collect it from your person, it's not canceled, right?
Right.
Does that make sense to that person? You want to type if it doesn't?
And actually, this is a person that she and I had talked about that previous question. So Leah, she might just be calling you directly to ask you some. I sort of volunteered you, Elizabeth, to talk to her.
That's fine. I'm not in my office today, though. She has to call me tomorrow.
All right, I think that's it then.
All right, everyone.
Leah just said she's going to be calling you. Thanks.
Okay, no problem.
All right, thank you.
All right, so I'm just going to put my stuff up here at the end. So. Well, you can see it at the end of your slides. That's how you reach me. Okay, you can email me. That email isn't so secure because it's run by Google now. So if you need to send me stuff, I have a secure email, or just white your client's information out of it. okay, because we can talk about them anonymously.
Okay. So
all right, everyone?
My office is closing in about 20 minutes, so I hope that everybody stays safe and warm, and good luck driving if you have to drive today.
And one last thing, Becky, we need to announce the CLE code for those
Oh,
of
yes.
you who didn't see it in the chat. It's 73A is an Adam -16. That's 73A is an Adam -16.
Perfect. Elizabeth, this was fantastic. Thank you so much for your help. Your presentations are always very helpful and engaging, and I appreciate your time.
Okay, everyone, thank you. Good luck with your homeowners.
Bye-bye.
Bye.